Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we had a busy week. There's been a lot of craziness in the market with yield curve, rates. So on the Econ Show, we covered a lot of that. And then I just did an article that is out there for free that you can take a look. I go through why is it happening? What does it mean? Even though, what is going to be the impact going forward? Because this does start to come into commodities. What does it mean for inflation and things of that nature? So, and then on the EIA show, we tried to break down what were the impacts of the Texas blackouts. What do we think is going to happen going forward? And we're going to have some more slides and updates on China. But then next week, we'll have a bit more on OPEC. What is happening going forward. We have some decent new data that has come out from the IMF and World Bank looking at some of the impacts of COVID and what they're expecting on growth going forward. So a lot to come, a lot to talk about, but rounding out the impacts from the Texas blackout, we have the Primary Vision Frac Spread show. So today we came in with 140. So if you remember, we had a frac spread count of 41 after pretty much everything went to zero across the South. So, and this is going to vary based on what you've heard, the things that we've done. So we have our algorithm that works. Then we go out and we try to get some color, just because obviously there's everyone's going to have a different story to tell. And we're seeing that at this point, they were about 85% normalcy across a lot of the different regions, with really the lion's share of the difference being made up, through next week with some residual that's going to come through. But growth is continuing. Like Baker Hughes said that they had an increase of 4 rigs. So, and just when you look at the crude curve and the fact that WTI is sitting at 62, there's a lot of incentive to get back to work. So this is something that's going to be quick, fixed pretty quickly. And as we talked about in the EIA show, the production, we were missing about 500 to 600,000 barrels. We've closed that gap a little bit more, but the remaining 250 will be fixed. It's just going to take a little bit longer, just based on some of the additional damage. So you can see that 140. But when we look at just kind of where we sat, you can see we started to see some of those impacts from weather, going from that 175 to 161. Then obviously we had the massive freeze off. And this isn't just people not freezing in terms of the water itself, but it's also power, who lost power, who couldn't get there because they lost power. So it was just essentially an all stop. You can see that the bounce back, it takes a little bit longer to get there, as we said last week and in last week's write-up, that we'll slowly get there, because right now we're going to start getting to that 170. We're starting to approach what it looks like, just based on commentary and what we're projecting out with our models, that we're going to get to. We're going to start getting pretty close to that 100 spread mark is in the Permian. So then when we look at just where we are, obviously it's the comps are going to start to get a little bit easier as we go into April, just as we had COVID ramping. But when we also consider, what is happening in the market in general, we have to look at, okay, well, Appalachia slowed a little bit, which is fine. It's just a matter of what's happening in general. The curve is strengthened a bit with the where the 5-year average is. So we expect to see some stabilization, especially in Appalachia. But then when we start turning to the Bakken, that's one where we normally start to see a pivot in, let's call it middle of March on a seasonal basis, just because obviously it's much easier to drill in North Dakota when it is, let's call it spring and not winter. So these are things that we're going to start to see. But again, we're at about that 80 to 85% mark in terms of activity normalizing within not just the Permian, but obviously the Eagle Ford and parts of the Haynesville. So then when we turn a minute to China, just because there's a lot of commentary that's come out of China, we wanted to round out, now that we're starting to get some updates as they normalize and come back from Lunar New Year. So here you can see that on the state-owned refiners, they're starting to accelerate a bit in some areas. They're still pretty far below seasonal norms, except in the south of China, which is not really surprising, just given where some of that demand is. And then the refinery run rates at Shandong are sitting at about 73%. They were coming down. Now we've seen them flatline a bit, which is a positive for seeing some of the pull through. Now, there was an article out today talking about how they're starting to run tight on onshore storage, which isn't surprising just given the lack of activity and what we've been saying with new purchases. So that's going to keep them it's going to keep their new purchases tempered a bit. And that's why we've been looking at kind of where things are. And then obviously there's always I'd say at least once every quarter, once every 6 months, there's an article about missing oil barrels. And it's just, when you think about calculating where oil is and where you're looking at imports and you're looking at exports of product and you're trying to figure out run rates, and there's always going to be that missing piece, because when you look at what, say, China is doing, they're importing, let's call it, just round numbers, 14 million, but they're operating, 13 million barrels a day in refinery throughput, which means that there's a breakdown or a missing million barrels. Like, where is it going? And is it going into storage? And if it's going to storage, is it commercial or state owned? And that's where you start to see these missing barrels. And when you look at the OECD countries, especially the US, we're very open about what's in our SPR. Other countries are releasing either once a month, twice a month, what's in their storage. And China, it just doesn't do that. So and if you think about it, that's why everyone's, where's the 800 million missing barrels? And I would guarantee you a large part of that is in China. But again, that's where we start looking and trying to figure out where are some of these different pieces. And this is where it's a bit more art than science, and why we focus so much on shipping and just what's happening on the floating market. So now that we also look at the crude stocks in Shandong, which is the independent storage, and you can see that we're at a seasonally adjusted high as we go through the pretty much as we head into the end of February and into March. We're going to continue to see this push to the highs that we had back in January. It was last year and the year before. But you can see the trend continues to go up, and we don't see them operating really too much above where they currently are. And it's just because the Lunar New Year was fairly slow in terms of demand, so it's going to take some time, and that's why we're starting to see some of those slowdowns in purchases. Now, when we look at fuel oil stock, that came down a bit, but you can see it's still at that elevated level, and that won't change too much, just because they're still trying to move stuff through the system now that truck drivers are back and things are starting to normalize. But on the other side, which is on a little bit bullish, as we've been talking about, Urals traded at a 10-month low. They have since bounced. They've risen about 60 to 70 cents off of that 10-month low. Still low on a spread level, but again, still not a positive to see. And as we were talking about, they were trying to find a place where they could finally say, okay, well, let's start clearing the glut. Now, on the other side, Angola is still very sluggish. They have about 7 to 8 cargoes left to go to sell in March, which is actually fairly late for them, because they typically will sell out most of March by this point in time. They might have 1 or 2 left, but that's why to have 7 or 8 is a bit concerning when you start looking at the West African grades, which is why we've started to see some rollbacks on OSP. Well, I should say the discounts to the stated OSP is starting to increase, just because they're trying to find ways to clear that glut. And then Nigeria launched or announced their OSPs, or official selling price. We'll talk more about that next week. But they kept things mostly flat, which is actually low for this time of year. And we'll show that against seasonal norms in terms of where they normally sit. So again, we're seeing that competition on the physical side with versus the paper, but obviously rates is going to start taking care of that, only because higher rates will initially mean that you're going to have a stronger dollar. And when you look at just crude, and obviously it's had a big run, and you're starting to see the dollar strengthen, so you'll start to see a bit more normalcy, or at least a little bit of a break or a pause in the rally of crude. Then when we look at Singapore, this is something that we always like to look at. So we had a build of about 1.4 million across the board. And this is just putting it into perspective as to where we are on the average. We normally have a build at this point in time. So there's nothing too concerning. This has actually flatlined a bit, and it's really being driven based on some of the residual fuel has normalized a bit because we continue to see builds and unseasonably big builds in some of the other products, such as middle distillates. So when we look at middle distillates at Singapore, you can see that they've continued to push up. Now, the hope is that this is going to normalize a touch as we see more product going from Singapore, South Korea into Pad 5 or the West Coast after the impacts from Texas. So this is going to help drain some of this down, put it on the water, and send it into our market. And then when you look at the light distillate side, we've pretty much flatlined. The issue right now is the petrol prices in India are at pretty all-time highs for gasoline, and there's some of those inflation fears that are coming through. And when you think about the U.S. rates going up, so U.S. rates typically set the standard, or a lot of other things will price off of those numbers. So as U.S. rates go up, and especially the rate of change, which was very aggressive, that will start to adjust how much easing can these countries do on a fiscal side, monetary policy side. And India is one of those key spots because a lot of the price is taxes. And the question is, can they support or cut some of those taxes? And that's where you're going to start to look at, well, what is the deficit? What are the receipts? And that's where it gets a little interesting. And then, we'll talk about it next week. But just to mention, the European data was fairly flat. There was a small build in gas oil, small draw in gasoline, but, net, nothing too crazy. And we're going to see some of those draws continue, especially on the gasoline side, as we get more shipments coming into the U.S. market, but also West Africa. So a lot to talk about, a lot of different things. Obviously, a lot of noise with the Texas blackouts. What is that going to mean going forward? But net, we have $62 oil. A lot of these guys have been able to hedge or at least get a bit more comfortable with where the curve is, which is why it's going to be a very interesting OPEC meeting, because we all know that Russia has been looking to temper some of this price rally. And when you start looking at some of the costs of the gasoline, diesel, and now you have inflation fears. Well, inflation, you want people driving, so you don't want gasoline too high, but you also don't want it too low. So this is where the market has some dynamics, and looking at trying to manage that is going to be difficult, especially when we start looking at OPEC with competing agendas. As we talked about, Iraq continues to go higher. And then when we talk about what's happening with Russia and Saudi, Russia would like to increase a bit, and Saudi would like to try to stay the course. And then before we go, we just want to provide an update on Iran. So the U.S. struck some key sites in Syria, and right on the Syrian border, and it's in response to the attack that happened on coalition forces, resulting in the death of a contractor and injuries to some coalition soldiers as well as contractors. So these are, people have asked, like, Mark, were you surprised? And the answer is no, because this is something that I think people were assuming Biden was going to be a bit softer. And we did a big show on Biden and Xi and Biden and China. And we don't think there's going to be too much of a deviation from the way that they're going to handle Iran, at least through the remainder of the year, and wait for those elections. They've tried to see, okay, let's take a temperature of where this is. Let's have a conversation quickly about what would it take to get this nuclear deal back on the table. And in response, there was obviously the problems that we saw on the attack on U.S. forces. And then when we look at, and as we said in the on the Econ show on the last segment, we talked about some of the recent upheavals within Iran. So again, they're seeing their pressure internally. They're seeing the Shia crescent come under pressure with Israel and other GCC or Gulf Cooperation Council members starting to renew ties, and that's putting more pressure on the Shia crescent, which is shrinking some of that capacity, shrinking some of that the ability to impact some of the region. And that's causing the regime to try to project strength. But now we're starting to see more riots. We're starting to see more, and it's happening right on the border with Pakistan, where we're seeing that's where the Iranian regime has the least amount of control. So it's not surprising to see that's where we're starting to get some of this increase. But the reason why we say that is because there's a lot of oil at stake, and we don't see that nuclear deal really coming to pass and unlocking all of these barrels. So that's one of the things that we're always going to look at and continue to talk about as we go through the remainder of the month and as we get closer to the OPEC deal, the OPEC meeting, and then what does it mean going forward. So hopefully this was helpful. You know, we always appreciate your questions, comments. So please let us know if you have anything or something you'd like us to cover. So thanks again for watching and have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.